In the year 2000, Enron reported $1 billion in net income. The stock was flying. Wall Street loved it. But one number told a completely different story. And 18 months later, the company was bankrupt. The number that exposed Enron before the world caught on isn't hidden. It's published every quarter, by every public company. Most investors glance right past it. I've watched 50 years of earnings reports. And I'll tell you something Graham taught me in the 1950s that Buffett repeats in every letter: earnings can lie. Cash cannot. Today, we're breaking down the one metric that separates real businesses from accounting illusions. By the end of this video, you'll never look at a stock the same way again. Let's start with a simple truth most investors never learn. Net income is an opinion. Cash flow is a fact. Here's what I mean. When a company reports earnings, accountants make dozens of choices. How fast to depreciate equipment. When to recognize revenue. How to count inventory. All legal. All flexible. And all open to interpretation. Enron was the masterclass in this. In 2000, they reported record profits. The stock hit $90 a share. Fortune named them America's most innovative company, 6 years in a row. But pull up their cash flow statement. Operating cash flow? Negative $154 million. The profits existed only on paper. The cash? Going the other direction. By December 2001, Enron was bankrupt. $26 billion in shareholder value, gone. And anyone who checked the cash flow statement saw it coming years earlier. This is why free cash flow matters. But what is it, exactly? Free cash flow is simple. Stripped of jargon, it's the money a business generates after paying every bill and reinvesting to stay competitive. The formula looks like this. Operating cash flow minus capital expenditures equals free cash flow. Think of it like your own paycheck. You bring home money. You pay rent, groceries, the electric bill. You fix the car when it breaks. Whatever's left over, that's yours. To save, to invest, to build wealth. Free cash flow is the same thing for a business. It's what's actually available to pay dividends, buy back shares, pay down debt, or make acquisitions. Buffett called this owner earnings in his 1986 Berkshire letter. He said, and I'm paraphrasing here, that owner earnings represent the cash a business owner could take out without damaging the company's competitive position. That's the magic of FCF. It answers the only question that matters. How much real money is this business actually producing, for me, the owner? And here's where it gets interesting. Two companies can report identical earnings. But one produces twice the free cash flow of the other. Which one is actually worth more? The answer is obvious when you know where to look. Let me show you a company that does this right. Apple. In fiscal year 2024, Apple generated $108.8 billion in free cash flow. Let that number sink in. $108 billion in a single year that the company didn't need to keep the lights on. That's why Apple can return money to shareholders at a pace most companies can't match. Share buybacks. Dividends. All funded by cash the business produces organically. No debt-fueled tricks. No accounting gymnastics. Now compare that to WeWork. In 2018, WeWork reported $1.8 billion in revenue. The founders were celebrated as visionaries. The company targeted a $47 billion valuation for its IPO. But the cash flow statement? A disaster. The company was burning through money faster than it was bringing it in. When investors finally demanded to see the real numbers in 2019, the IPO collapsed. The valuation crashed from $47 billion to roughly $8 billion in weeks. Same year. Same economy. One business printed cash. The other consumed it. The stock market can ignore that gap for a while, but never forever. Here's the simple check I do on every investment. I calculate free cash flow yield. Take the annual free cash flow. Divide by the company's market cap. If I get above 5% on a stable, growing business, that's interesting. Below 2% on an unprofitable company? I walk away. Every time. Now here's the third lesson, the one most investors get completely wrong. It's not enough to look at free cash flow once. You have to watch the relationship between earnings and cash flow over time. When earnings keep climbing but free cash flow is flat or falling, something is wrong. The accountants are working harder than the business is. This is exactly what happened at General Electric under Jack Welch. For years, the stock was a Wall Street darling. GE earnings grew like clockwork. 60 quarters of hitting estimates. The stock peaked near $60 a share in 2000. But underneath, the cash flow told a different story. GE Capital was smoothing earnings. Pensions were being managed creatively. When the financial crisis hit in 2008, the illusion collapsed. GE lost more than $200 billion in market value. The dividend got slashed. Investors who'd trusted the earnings story for decades watched their retirements disappear. The cash flow statement had been flashing red for years. This is why I tell every investor the same thing. Read the cash flow statement before you read the income statement. The income statement is what management wants you to see. The cash flow statement is what actually happened. Here's what 50 years has taught me. Every great investment I've ever made was a business that generated more cash than it consumed. Every disaster I've watched was a company that reported profits while hemorrhaging cash. Earnings can be engineered. Cash cannot. Learn to read the cash flow statement, and you'll spot both the winners and the frauds years before the market does. Here's my question for you. What's the worst earnings versus cash flow gap you've ever seen in a company you researched? Drop the ticker in the comments. I read every one. And if this changed how you think about evaluating stocks, hit subscribe. Tomorrow we're covering the investor who turned a family textile mill into an $800 billion empire, and the one insight he discovered at age 25 that changed everything. This is educational content, not financial advice. Always do your own research.